NIO stock took a beating in Friday's session, dropping 10%, or about 75 cents, to close the day at $6.71 per share. It was one of the steepest single-day losses in recent months and came amid a broad market sell-off following new comments from former President Donald Trump about tariffs on Chinese goods. The remarks reignited fears of a renewed trade war and sent shockwaves through sectors heavily linked to China, including the electric vehicle space. For NIO investors, this was an unwelcome turn after weeks of relatively stable trading in the $7 range. The stock had shown encouraging signs of consolidation around support, but Friday's sell-off demonstrated just how sensitive the market still is to geopolitical rhetoric. In reality, this wasn't just about NIO. It was about macro-level sentiment, trade uncertainty, and the fear that escalating US-China tensions could once again disrupt global supply chains and investor confidence. Let's unpack what's really going on. The market's reaction started early in the session after Trump threatened what he called massive tariffs on Chinese goods. He also hinted at a possible new phase of economic pressure designed to curb what he described as China's unfair advantage in global manufacturing. Reports surfaced that a scheduled meeting between US and Chinese officials had been postponed, which investors interpreted as a sign that diplomatic relations were deteriorating. That news alone was enough to spark selling across multiple sectors, from technology to electric vehicles to rare earth materials. When markets move on politics, they tend to move fast, and Chinese-linked equities are often first in line. NIO, Li Auto, XPeng, and BYD all saw heavy losses throughout the day. Investors immediately priced in the risk that new tariffs could limit exports, slow growth in global demand, and disrupt cross-border manufacturing. Even though NIO's exposure to US tariffs is relatively limited compared to more export-focused peers, the perception of risk was enough to drive selling pressure across the board. At the same time, the decline wasn't entirely out of nowhere. The Chinese EV sector has been under quiet pressure in recent weeks, largely due to Beijing's upcoming 2026 export permit system for electric vehicles. Under the new rules, Chinese automakers will need to apply for government approval before shipping EVs overseas. The policy is framed as a quality control measure aimed at improving the reputation of Chinese brands abroad, but investors worry it could slow growth and add bureaucratic friction. When news of new tariffs breaks, those existing concerns suddenly feel much heavier, and that's exactly what we saw on Friday. The broader markets also reinforced the sell-off. The S&P 500 and Nasdaq both declined sharply as investors rushed out of risk assets. Bond yields climbed, the US dollar strengthened, and traders shifted toward defensive positions. In that kind of macro environment, volatile growth names like NIO usually take the hardest hit. What's important to note is that this was not just about company-specific weakness, it was a symptom of global risk aversion. Tesla, for example, also traded lower early in the session before recovering slightly. That recovery shows that EV stocks as a group were pressured, not because of individual earnings or deliveries, but because of macro fear. For NIO, which already carries the weight of being a Chinese-based company listed in the US, those fears often amplify. So what does this mean for investors? The first takeaway is that volatility remains high. A 10% move might sound extreme, but it's becoming more common in an environment where headlines dominate sentiment. This is the same dynamic we saw in 2018 during the first year of the China trade war, where small policy statements triggered outsized market reactions. It's emotional trading, not necessarily a reflection of fundamental value. Speaking of fundamentals, NIO's recent business performance remains intact. The company continues to post record delivery numbers, with September's total reaching 34,749 vehicles, and third-quarter deliveries surpassing 87,000, a 40+% increase year-over-year. Those figures demonstrate that demand remains strong even as the competitive landscape intensifies. NIO's battery swap network continues to expand, giving it a service edge that few competitors can match. The company has also reduced its short interest by more than 5% in the past month, bringing it to just under 10% of the float. That's a significant improvement and signals reduced bearish sentiment in the medium term. In other words, the fundamentals didn't suddenly change on Friday. What changed was the narrative, and narratives are powerful in markets driven by emotion and news flow. Traders went from cautious optimism about stabilization to panic selling over renewed geopolitical tension. The irony is that these moments of panic often set up the conditions for the next recovery. If we look at the technical picture, there are some clear levels to keep in mind. The $7 line has acted as both support and resistance throughout the past 2 months. Friday's close below that level will grab the attention of chart watchers. The next key area of support sits around 650, which marks a previous consolidation zone from late September. If NIO holds that area in the next couple of sessions, it could signal the beginning of a stabilization phase. On the flip side, a strong close back above $7 early next week would indicate that Friday's decline was more of an emotional flush than a sustained breakdown. The volume behind Friday's move was unusually high, which suggests that some large institutional players may have been trimming exposure across Chinese equities. But it's also possible that much of the decline came from algorithmic trading triggered by the broader market drop. Those kinds of mechanical moves often overshoot fair value and then correct once calmer conditions return. So, while it's never fun to see a double-digit loss in a single session, long-term investors should remember that volatility cuts both ways. The same macro forces that push NIO down 10% in a day can just as easily propel it up 5 or 6% when sentiment reverses. And given that short interest is now lower, any future recovery could happen quickly if traders decide to reposition once the dust settles. Looking ahead, the focus should shift to 3 key areas. First, watch the geopolitical headlines. If rhetoric between the US and China cools over the coming days, risk appetite could return to the market. Historically, many of these tariff announcements have been followed by periods of negotiation and partial rollback. If that pattern repeats, EV stocks could rebound sharply. Second, pay attention to the next round of macro data. With inflation and employment numbers due next week, traders will be watching closely to see if the Federal Reserve maintains a hawkish tone or signals patience. A softer stance from the Fed could improve liquidity conditions and support growth names like NIO. Third, stay alert for updates from within China's EV ecosystem. If companies like BYD, XPeng, or Li Auto issue positive production or delivery guidance, it can have a spillover effect that lifts sentiment across the sector. NIO remains one of the more sentiment-driven stocks in this group, so momentum from peers often matters just as much as its own headlines. From a psychological perspective, this kind of sell-off tests conviction. Traders who bought into the recent rally may be quick to exit, but long-term holders often use these dips to accumulate. Historically, some of NIO's strongest recoveries have come after capitulation-style declines. The question now is whether Friday's drop was the start of a new downtrend or the end of a shakeout. The answer will depend largely on how global markets respond to political headlines in the coming days. If cooler heads prevail and broader risk sentiment stabilizes, NIO could find its footing again above $7. The fundamentals certainly justify it. Deliveries are rising, the company's brand strength is improving, and it continues to carve out a distinct identity in the premium EV market. While the political climate adds uncertainty, the underlying business case remains intact. It's also worth noting that Chinese policymakers are expected to continue supporting the domestic EV industry through incentives and infrastructure spending. That creates a buffer against external shocks. And if Beijing responds to renewed trade tensions with economic stimulus measures, companies like NIO could actually benefit. In short, Friday's 10% decline reflects fear, not failure. The company didn't miss earnings, announce a recall, or lose demand. It simply became collateral damage in a market driven by geopolitical noise. These are the moments that often separate traders chasing headlines from investors focused on fundamentals. The road ahead won't be easy. As long as trade tensions dominate the narrative, volatility will remain elevated. But history shows that sentiment shifts quickly. When the market eventually refocuses on the numbers, not the noise, NIO's consistent growth, falling short interest, and improving margins could reassert themselves as the primary story. So, while it's tempting to see Friday's close at 671 as a red flag, it might instead be a chance for perspective. The stock has faced setbacks before, regulatory worries, price wars, sentiment shocks, and each time, it's found a way to stabilize. Whether this moment becomes another turning point will depend not on politics, but on patience. As we head into the weekend, investors would do well to remember that volatility is the price of opportunity. NIO remains a company with strong operational momentum, a loyal customer base, and long-term ambitions that extend far beyond the headlines of any single week. Friday's sell-off may have been loud, but in the grand scheme, it's likely another chapter in the ongoing story of a company navigating and surviving the crosscurrents of a global market in flux.